Welcome, everyone, and thank you for attending GreenPath Financial Wellness webinar, Understanding Your Credit Report and Score. GreenPath is a trusted national nonprofit housing and financial credit counseling agency, and our mission is to empower people to lead financially healthy lives. We started as the budgeting service of the Michigan Credit Union League in 1961, and we've grown into a nationwide financial wellness organization. We counsel in all 50 states and in Puerto Rico, and we believe that financial education is something we should all continue to engage with, regardless of how much we already know. There is always something that we can learn to help maintain or improve our financial wellness. Today, we'll talk about the topic of understanding your credit report and score. My name is Jessie Garrison, and I've been in the financial industry since 2005. I'm glad to be here to share some information with you today about why your credit report and your credit score are so important in many different areas of your life. I'm also joined today by Eli Garcia. Thank you for joining me, Eli. Take a moment to introduce yourself.
Thank you, Jessie. It is truly a pleasure being here with you. Welcome, everyone. We're so glad that you could join us today. My name is Eli Garcia, and I work for Schools First Federal Credit Union. I work in the loan servicing collections department, and I've been in the financial industry since 2013. And actually, I love what I do because Schools First Federal Credit Union works diligently to set our members up for financial success. With the partnership we have with GreenPath, we're able to accomplish that and much more. Jessie, would you like to share what we have on today's agenda?
Absolutely. Thank you. We do have a lot to cover today. It's very exciting stuff. This is all key to understanding your credit report and score. We'll start out by talking about why credit is important. We will also take a look at credit reports, what's on them, and how to obtain your own. We'll talk about how credit scores are calculated and how to build or improve credit. We'll also talk a little bit about some common myths, and we'll wrap up with some tips on using credit cards wisely. So again, anytime you have a question, please throw those in chat, and we will have time at the end to answer any questions. As we get started on the ins and outs of credit reports and scores, it's important to take a step back and consider why credit is important in the first place. Let me start by asking you, please share your answers in chat. What are some examples of things that you have needed credit or credit scores for in the past? What are some examples of things that held you back because you maybe didn't have sufficient credit? So yeah, why is credit important? I see a few things coming in the chat here. If you want to get a new loan, a new mortgage, purchasing a home, auto loan, purchasing a home or a car. Renting, yes. Thank you for who shared that. Renting, it is important as well. Education, yep, absolutely. Insurance, yes, thank you. Absolutely. See, you're already experts here, so you're coming to learn more, and I appreciate that. So yeah, buying a home, buying a car, education, insurance are all great things. I see renting. Yep, absolutely. So have you ever thought about how credit could play a role in getting your dream job? Did you know that 38% of employers do credit checks? This does not mean that having bad credit will prevent you from finding a job. However, it may be used in determining if you will be offered jobs. It's important to note that employers will only have access to your credit report and not your credit score. And whether or not credit is a factor in gaining that employment largely depends on your industry. If you work in finance like Eli and I do, it could be a bigger factor. It's also a big factor for jobs requiring security clearance. For example, if you want a job at any airport, the TSA or Transportation Security Administration, they do a credit check on all prospective employees. If you owe $7,500 or more in unpaid debt or debts and collections, they may only hire you if you show a plan to pay the debt back. Your credit history comes into play when you rent or buy a home. Even though renting does not actually involve borrowing money like you would to purchase a home, most rental management companies will still want tenants with decent credit, as it indicates that you are going to pay rent as agreed on that monthly basis. If you're purchasing a home, credit will absolutely play a role in determining if you're eligible for the mortgage and what interest rate you're eligible for. We also think that having good credit may make the difference in getting a loan when you need it. Anytime you need to borrow money, your credit is going to play a pretty big role in determining the terms of the loan. However, what happens if you want to borrow money and you don't have good credit? I'm sure we've all seen and heard the advertisements that say, bad credit, no problem. No credit, no problem. While these places can often approve you for the loan, it could be an extremely high interest rate. For example, you might get an auto loan at 25% interest rate. That might translate to a monthly payment that is double or triple what someone else with better or good credit might pay. Let us take a quick look at two people applying for a $250,000 mortgage for a 30-year fixed rate. For the sake of our discussion today, we're going to say all underwriting pieces for Diego and Angela are equal. They have the same amount of income, the same stability of income or the length of employment. And while Diego and Angela may both get approved, we want to take a look at how their difference in their credit score impacts the terms of their loan. So we see here, Diego has a credit score of 660. His interest rate on his mortgage is going to be 5.25%. His monthly minimum payment for his mortgage and interest is $1,381. And the total paid of principal and interest over 30 years will be $496,984. Now let's look at Angela. Angela has a credit score of 750. She's approved for an interest rate of 4.63%. That brings her monthly minimum payment down to $1,285. And the total principal and interest over 30 years is $462,000. While it may not seem like a big difference, this dollar amount and this interest rate spread out over 30 years on a large loan, that difference could, in the credit scores, could make a difference of thousands of dollars. We see in this example that having a higher credit score could save Angela $34,000. Now, Eli, do you have any advice that you might give Diego in this situation? What advice would you give him before he decides whether or not to move forward and purchase this home at this time?
Well, Diego may want to consider focusing on improving his credit score before buying a home. Often people are so eager to purchase a home because they don't know that they don't want to miss out on that boat. So in terms to say, right? And just to save lower interest rates or low real estate prices. However, jumping into such a large purchase before you are ready to credit wise, like before you're credit wise or credit worthy, may mean your dream home become more of a nightmare. So you want to just prepare yourself before you look into that financial decision.
Great advice, Eli. Thank you.
So now, let's turn our attention to credit reports, as a credit report contains some of the most important pieces of information creditors look at when determining if and what terms they are willing to extend credit to you. So just remember, if you have any questions at any time, please put it into the chat. We will review all of your questions at the end of the presentation. So there are three major credit bureaus that collect your information and generate credit reports. That's TransUnion, Experian, and Equifax. When it comes time to apply for credit, different financial institutions may review different credit bureau reports. In some cases, like when applying for a mortgage, the lender may review all three credit bureau reports. This is part of why it is important to be on top of what is reporting with all three credit bureaus. And it is recommended you review your credit report from all three credit bureaus once a year. You can do this all at once or stagger your reports throughout the year. Ask your financial institution which report they typically pull and start with that report. Set an alert on your calendar to pull the second report 4 months later and the third report another 4 months later, ensuring you are reviewing a credit report every few months. Now, different information may report to different credit bureaus. In many cases, the information will vary slightly as some creditors may only report to one bureau versus all three and may report at different times. So, what's on your credit report with each of these three credit bureaus? First, your credit report contains your identifying information. This includes your name, social security number, date of birth, address, and employer. This is used so that whoever is accessing your credit can match up your information. This personal information is not used when calculating your credit score. If you're a junior or a senior, pay extra close attention here to ensure that the information is reporting correctly. We all want to pay extra close attention to middle initials as well. Secondly, we have credit accounts that will be on your credit report. This includes credit cards, personal loans, auto loans, mortgages, student loans, and other types of debt. Your credit report will contain information about when you opened the account, if your payments have been made on time or not, your remaining balances, and other maximum credit limits. Payments will show up as late if you are 30 days or more past due. There are other household bills such as rent or utilities generally do not show up on your credit report. However, if you were to stop paying on all of these bills, they can be referred to a collection agency. Once in collections, the collector can report the debt, at which point those outstanding debts would appear on your credit report. Under the Fair Credit Reporting Act, debts can generally appear on your credit report for 7 years, and in few cases, longer than that, depending on the credit bureau. Now, public records, which can include things like bankruptcy, tax liens, or judgments, those can stay on your credit report from 7 to 10 years, once again, depending on the reporting. And finally, anytime someone accesses your credit report, it's called an inquiry. There are two types of inquiries. There is a hard inquiry, which is anytime your credit report is reviewed for the purpose of extending credit, such as applying for a loan. And then we have a soft inquiry, which includes checking your own report or when a current or potential creditor wants to make you a promotional offer. While both hard and soft inquiries will appear on your credit report, only the hard inquiries impact your credit score. What is not on your credit report? Your credit report does not contain information related to income, assets, or savings. So a person can have excellent credit, however, no savings, or on the other hand, be very wealthy, however, have poor credit. This is why lenders will often look at all of these pieces of a financial picture or financial situations together, such as income, assets, savings, and credit, when making any lending decisions. Remember, a credit score is not a financial health score. There is no requirement in the Fair Credit Reporting Act for reporting agencies to remove positive information, such as on-time credit payments. They can remain on your credit report indefinitely, especially if the account remains open and active. Even after a positive account has been closed or paid off, it can still remain on your credit report for as long as 10 years. Having additional good information helps strengthen your credit history and increase your credit score. Now, Jesse, can you tell us more about how to obtain a credit report?
Thanks, Eli. It is important that information on your credit report is accurate. According to a study conducted by the Federal Trade Commission, or FTC, 1 in 5 people actually have an error on at least one of the 3 credit reports. Let's talk about how to get a copy of your credit report. It is recommended that you review your credit report from each of the 3 major credit bureaus at least once per year to make sure that everything is accurate and ensure that you are aware of everything that is being reported. The recommended place to get your credit report is called annualcreditreport.com. Very creative website, annualcreditreport.com. We also want to make sure that this is the website that you're going to. This is the website that was set up in accordance to the Fair Credit Reporting Act that says that you have a right to receive a copy of your free credit report from each of the 3 credit bureaus. The law was originally that you could get one from each of the 3 credit bureaus once per year. The law has recently changed and you can now access your reports for free once per week. When you go to annualcreditreport.com, you should see the same logo as you see on my screen now. It is best to type this full and exact website into your internet browser, as there are a lot of imposter sites. Confirm that you see this logo, annualcreditreport.com, the blue and the red text. That will indicate that you are in the correct website. You can scan the QR code now if you'd like to pull that up. If you get there and you're being asked to pay for your credit reports, you are in the wrong place. This is for free, annualcreditreport.com, and you can get one report from each of the 3 credit bureaus all at the same time, or you can stagger them and do them at different times. Before receiving your credit reports, you will be asked several security questions. There may even be trick questions. For example, it might say that you opened a mortgage in May 2008 and asked the name of the lender. If you've never taken out a mortgage, the answer might be NA or not applicable. Maybe you took out a mortgage in May 2012. So again, if that answer does not show up, then that's not the correct answer. And keep in mind that these questions are meant to ensure that you are who you say you are. There is also a form that you can use if you prefer to request your credit report via mail. The form can be found online at annualcreditreport.com, or you can call 877-322-8228 to receive it. You can also send them a letter at P.O. Box 105-283, Atlanta, Georgia 30348. If you anticipate the need to borrow money, we do recommend you review your credit reports at least 6 months prior. And that way you have the ability, if there are any errors, to have the time to correct the errors before you apply for the loan. Please note that only the credit reports are free. If you wish to obtain your credit score, there is typically a cost of $6 to $8 per credit bureau. Again, there is a law that requires the lender to provide the credit score they used if they make an adverse action or a denial on a decision for an application for credit. This includes being denied for a loan or a credit card, or getting an interest rate that was approved at a less than the best rate being offered. It is not recommended that you apply for a loan knowing you will be denied just to get access to a free credit score. As we discussed, applying for too much credit could actually hurt your score. If you do find inaccurate information on your credit report, you have the right to file a dispute. First, you'll want to dispute the item with the creditor or the collection agency that reported to the credit bureaus inaccurately. So let's say you have a Visa card, there was a charge that was not correct. You want to dispute that with the Visa company first. If that does not resolve the issue, you can then file a dispute with the credit bureau that is reporting the inaccurate information. You should include any documents just to support your dispute and allow 30 to 45 days for the credit bureau to complete their investigation. Please note that the credit bureau requires you to provide proof of your claim that there is or was an error. Just because you submit a dispute does not mean something will be removed from your report. If you do not submit the proof, there is less chance the credit bureau will remove something from your report. If you are still unsatisfied with the outcome of the dispute, you can and should file a complaint with the Consumer Financial Protection Bureau. Please call them at 855-411-2372, or you can go online at consumerfinance.gov/complaint, or you can scan the QR code that you see on your screen right now. If you find any indication your identification may have been stolen, it is important to take action immediately. Your first step should be to file a police report. And then you're going to want to contact all 3 credit bureaus to place a freeze on your credit reports. This prevents anyone who has your information from continuing to open accounts as you. You can typically do this by calling the credit bureaus or going online to their websites. It is important to note that this freeze prevents anyone from applying for credit with your information, including yourself. So if you do plan to apply for credit in the future, you will need to contact the credit bureaus to temporarily lift the freeze. It is also recommended that you file an identity theft report with the Federal Trade Commission, or FTC, at identitytheft.gov, or again, you can scan the QR code on your screen now. This report will walk you through additional steps that you may need to take. Eli, tell us next more about what is on the credit report.
Making sure you understand what is on your credit report and making sure the information reporting is accurate is very important, because your credit report is used to calculate your credit score. So let's go into what is a credit score. It is a 3-digit number that uses the information on your credit report to quantify the likelihood of repayments by reviewing how you have managed previous accounts. It is meant to reflect how risky it may be for a creditor to extend new credit to you. Scores range from 300 to 850, although it is possible to have a 0 if you have never had any credit history at all. The lower the credit score, the higher risk an individual appears to a creditor. The FICO score is the most widely used scoring model. So another model is the Vantage score, which is often used by sites that offer free credit scores. Because there are different credit scoring models, your score may vary depending on where you check it. This does not necessarily mean one is wrong. It just means different scoring models look at things slightly different. Now, there are 5 key factors that go into the calculation of your FICO credit score, which again, the most common scoring model used by creditors and lenders. So we have the largest factor impacting your credit score is payment history, which is 35%. Making every payment on time every month is one of the very best things you can do for your credit. Second largest factor impacting your score is amounts owed, which include credit utilization, which is 30% of your score. Creditors want to see a loan balances decreasing, not hovering at the same amount or increasing over time. Credit utilization specifically looks at the revolving credit accounts, like a credit card, where your balance could go up 1 month and then go down the next. Credit utilization looks at how much of your credit limit you are using. The more credit limit you are using, the more risk you are to a creditor. If you have multiple credit cards, add up your balance and divide them by the total of your maximum limits, and that is your utilization rate. Ideally, you do not want to use more than 30% of your limits at any given time. And even more ideally, pay your balances off monthly. Now, the next one, we have the length of credit history, which is 15% of the score. This looks at how long your credit accounts have been open, and this also includes the age of your oldest account, the age of your newest account, and the average of your accounts. So the longer the credit history, the better. If you're just starting out with your credit, length of credit history is only improved with time. So that means more months and more years with credit. So just be patient. Sometimes it's a little bit difficult, but patience is sometimes hard. Nothing else to do here. Just, pay as you can. Do your due diligence. Now, up next, we have our new credit, which is 10% of your score. This is where those hard inquiries we discussed earlier are reflected on your credit score. If you start applying for credit frequently, this can be a red flag to creditors because they start to wonder what is going on that you suddenly need a new credit card 1 month, a new loan the next month, and now you're asking for another new credit card this month. Of course, we typically all need to apply for credit from time to time, which, it's understandable. The key is being strategic with when you do apply, limiting those hard inquiries to only when you need it. Hard inquiries typically remain on your credit report for 2 years. And finally, we have our credit mix, which is about the last 10%, that is the last 10%, the last factor that impacts your credit score. Creditors want to see that you have a history of managing different forms of credit at the same time. For example, maybe a credit card and a car loan or a student loan. This is one of the smallest factors impacting your score. However, it can help to have a well-rounded mixture of types of credit when they're all managed responsibly. Although some areas have a larger impact on your credit score, all five of these factors play a unique and important role in calculating your scores. So this would be a great time to do a screen grab if you want to take an image of this. Now, let's apply what we've learned about credit scores. For example, we're going to take a look at Diego and Angela once again. For our purposes, each of them only have one credit card on their report. Diego spends $800 on his credit card each month. His limit is $1,000. Each month, when his bill arrives, he pays the entire balance off, avoiding any interest charge. Now let's look at Angela's situation. She carries a $5,000 balance. She also pays on time, however, is only making minimum payments. Her limit is $10,000. Let me ask you, share in the chat, who do you think has a better credit score and why? Okay, thank you guys for sharing. Appreciate it. I see Diego. I see Angela. All right. So let's see what we have here. Now, in this particular example, Angela has the better credit score due to the fact that her utilization percentage is at 50%, whereas Diego has an 80% utilization rate. Even though Angela is more in debt and will probably take more years to pay down her balance, plus a bunch of interest, there's one thing working for her: the ratio of her balance to her overall limit. Now, that being said, while Angela may have the higher credit score, Diego may be in a better financial position overall. Next month, Diego may simply charge less on his card, and within 30 days, his score should improve. Angela may struggle to pay down her debt because she's only able to afford the minimum payments. So just remember, credit scores are a piece of your financial situation. However, it is important to remember a credit score is not a financial health score. Now, Jesse, can you help us on how to build credit?
Yes, let's turn our attention to how you can build credit or improve credit if you've had a setback. So if we want to build credit, if you've never had credit, or if you're trying to rebuild following a setback. As you focus on building credit, you will want to review your financial goals first. Knowing what you are trying to accomplish will help you to determine the steps that are best for you to move forward. Also, before building credit, you want to consider how financially stable you are. Have you developed a written budget? Do you have consistent income, and is it enough to cover your everyday monthly expenses? Do you have at least several $100s in case of an emergency? You have like several $100s in a savings account to cover a minor emergency? If you open a credit card or add a new loan payment when you're already struggling financially, this could end up negatively impacting your credit score. One of the most common ways to build credit is by opening a credit card, especially if you're just starting out at the very beginning. Using a credit card for an already budgeted expense and paying the balance off in every month is a great way to start building credit and a strong credit history. Credit cards can be unsecured or secured. Unsecured credit cards are the most common cards you would see out there today. A secured credit card actually requires you to make a cash deposit up front, and then that deposit amount becomes the limit on the card. For example, the cash deposit you have is $300. You would then be in turn given a credit card with a limit of $300. And just like a regular or an unsecured credit card, you would use the card and get a bill each month with a statement balance and a minimum monthly payment amount due. You would also still pay interest if you do not pay the balance in full. If you make a payment late, you would still be assessed a late fee, and that may negatively impact your credit score. Your security deposit would only come into play, or it would be used if your account goes into default or is not repaid. Other than making a security deposit up front, the key in treating a secured credit card is like using the same as an unsecured credit card. Keep your balance low and make your payment on time every month to build positive credit history. A secured credit card is often used to help people with no or low credit rebuild, as there's less risk to the issuer because of that security deposit. As your credit score improves over time, you may eventually receive your deposit or your cash back from the creditor, and it may turn into an unsecured credit card. Please keep in mind that prepaid debit cards are not the same as secured credit cards. The prepaid debit card works more like a gift card, and they do not report any information to the credit bureaus. There's also an option for a secured loan. This may be a good way for you to build credit. With this type of loan, a deposit is also used, and in turn, they give you the cash back in a form of a loan. And then you would make fixed monthly payments on the loan until it's paid back and paid in full. With this type of loan, you would also pay interest on giving them your money and then borrowing it back. You may consider setting up payments to come out of your bank or credit union account to pay this loan automatically, and that may help to ensure that you have on-time payments. You will always want to talk over the options of building credit with your financial institution to make sure that you are using the right product based on your financial needs and goals. You also have two choices when it comes to using someone else's credit to build your own. The first of which is being to get a co-signer for a loan, or you would get a joint owner for a credit card. It is very important to know, however, that both parties are legally and equally liable for the debt on a joint account. If you plan to go this route, there is risk involved, and it is important to weigh the pros and cons and have a clear agreement in place with the other individual. Another option is being added as an authorized user to a credit card. Unauthorized users are not considered account owners, and you are not legally responsible or liable for the amount of debt. Please keep in mind that any activity on the account will be reflected on your credit if you're the authorized user, whether good or bad. If you are considering asking someone to add you as an authorized user, make sure it's someone you know and you can trust to make their payments on time and keep their balances low to ensure this actually helps to build positive and good credit history and does not end up harming your credit score or your credit report. I want to give you an example of why you might like to consider using an authorized adding an authorized user to an existing account. Say, for example, if you're the parent of a teenager. As the parent, you may consider adding your teenager as an authorized user to help build some credit history before they turn 18. Now, a couple of things to consider when doing this. Does the teenager actually have access to the card to swipe, to use, to spend on? Or are they only an authorized user in name only, like they don't have access to that card? With on-time payments and a low credit utilization for 2 to 3 years before they turn 18, this should give that teenager a good head start on showing good credit history in order to be approved for their own credit applications once they turn 18.
Now, let's turn our attention to a couple of the most common credit-related myths you have heard and why they're not necessarily true. So let's go with myth number one. It's something we hear a lot. Closing a credit card will always hurt my credit score significantly. This is more like half myth, and it depends on the person's situation. So let's take a look at a couple examples. So let's look into Sarah's case. She has 3 maxed out credit cards. Since she is using 100% of her available credit, the utilization portion of her score is already suffering. Now she pays off the first card, and so her available credit increases. Therefore, her credit score improves. She then decides to close it, so she is not tempted to use it again. However, once she closes the card, her available credit on that credit card disappears. She's now left with a utilization ratio of 100% once again, and her score goes back down because, remember, the other 2 credit cards remain maxed out. This was also Sarah's oldest account. She had this card open for 8 years. So closing this account is going to impact her length of credit history. In Sarah's case, closing her card has hurt her credit score significantly. Now, let's look at Katie's case. She has 5 open accounts, and her utilization ratio is great since she's using very little credit. Closing her newest card will likely have very little effect on or hurt the utilization ratio and less of an impact on the length of the credit history. So her credit score will not be affected as significantly as Sarah's, though she may still see some impact initially. This is another good reminder that credit scores are not financial health scores. Sarah closed that card to remove the temptation to continue charging on it. Yes, her credit score may have been impacted negatively. However, she made a financially wise decision for herself for her bigger picture. Another reason setting your goal is an important part of this. If Sarah's goal is to get her debt paid off and she is not planning on needing to apply for any new credit anytime soon, her goals can help her make different decisions than if her top priority is improving her credit score ASAP to get the best rate on any new loan. Let us look a little closer at Sarah's situation again. Jesse, what advice would you give Sarah before closing her credit card?
My advice is again dependent on Sarah's goals. If her goal is to improve her credit score as soon as possible, then I would not recommend she close the card. I might talk to Sarah about how much money that she has to make that large payment. If she was going to pay off one of those credit cards in full, I might recommend that she take a large chunk on each of the three instead of one. And that way, that'll get that utilization lower on each card instead of paying just only one card in full. Also, depending on Sarah's financial goals, maybe it is to close the card. Maybe that is a goal of hers to avoid paying an annual fee. If she has no need for new credit soon, she may not worry so much about a slight dip in her score because a card closed. As she continues to pay on time and pay off the other two credit cards, her utilization will be better and the on-time payments continue. She again will see her score come back up in the coming months.
Thank you for sharing that. Those are some really great examples. Now on to
Myth
excuse me,
number two.
that was number two, excuse me. Share with us in the chat. Have you heard that you should not check your credit because it will hurt your credit score? Share with us in the chat. Have you ever heard that to not check your credit score because it's going to hurt your credit score? I see yeses. I see no. We see that some believe that was a hard inquiry. Okay. Thank you all for sharing. We greatly appreciate that. Now, checking your own report is considered a soft inquiry and has no impact on your credit score. Check your own report or score as often as you like. It will not change your score. This myth is derived from the fact that applying for a credit too often can hurt your score, like we discussed earlier. When you apply for credit, it is considered a hard inquiry, which is different from the soft inquiry when you check your own credit score. Jesse, would you like to give us some tips of using credit cards wisely?
Yes, thank you, Eli. Since credit cards are one of the most common methods people use to access credit, let us wrap up our time together with some tips for using credit cards wisely. A great place to start is to have money in savings. Using this money in savings as a backup in case of an unexpected expense, you can use that savings instead of getting into debt with your credit card. Second tip, consider only making one charge per month and make this charge a regular monthly bill, such as a utility bill, internet, cell phone. The reason we suggest setting up only one regular monthly charge is that you only need to generate activity to build your credit score. It does not matter how much activity. And in fact, we learned the smaller the balance, the lower the utilization. And that's also something that could help improve your score because utilization accounts for 30% of your FICO score. Committing to use the card for only a small regular expense every month that you would already automatically pay for, and then consider adding automatic payments to pay for that monthly charge to pay the credit card. Maybe then using this system and leaving the credit card at home may help you avoid temptation to overspend. I think I mentioned in my introduction today that I've started in the industry in 2005 while I was a banker at a credit card issuer at a company. And I would say, okay, if this credit card application is truly as an emergency, then get the card when you get it out of the mail, put it in a glass of water and put it in the freezer. And now you have frozen assets. In case of an emergency, you can defrost that card and use it, but it's not burning a hole in your pocket to buy those new shoes or DoorDash or whatever falls in your cart at the grocery store, right? There's always something that falls in our cart. I don't know how it works in your household, but there's always something in my household. Third tip, the lower the utilization, the better. I think you've heard us say this a couple times now. The general rule of thumb is to use less than 1/3 or lower than 30% of your available credit. For small spending limits, this means only charging a very small amount. Keep in mind, it's important to know both the limit and what is that 30% number. Fourth tip, while paying off an account in full does not necessarily improve your credit score exactly, paying on time is what matters the most. Paying off the balance in full each statement cycle can help you avoid paying additional interest charges. It will also help you to live within your means without increasing your debt. And finally, be sure to check your credit report and keep an eye on your credit score regularly for accuracy. We want to make sure that you also know that GreenPath provides a variety of free resources, and I encourage you to take advantage of these. A few worksheets and guides that you see on your screen now. One is talking about understanding your credit report and score. We had a question earlier in the chat that I saw. So these are some resources that you can go ahead and download online by scanning this QR code now, or we will share these resources with you along with the meeting recording. You can take a look and find these resources and more at my.greenpath.com. Additional free resources that are available in the GreenPath Learning Lab Plus. This is our online digital portal. 2 courses that relate to our topic today is making the most of your money. Again, you can find these at my.greenpath.com or scan the QR code you see online now. And the next one is a second course that relates to our topic today is A1 Credit Tool. In the industry, if you have A1 credit, that's the top tier of the credit FICO score area. And so this is a great addition to our conversation to learn more about how you can get to the point of having A1 credit. Again, you can find the course on my.greenpath.com or scan the QR code that you see on your screen. These courses are available 24/7 and there is no cost. Additional resources, if you would like to talk with someone, if you'd like to take a closer look at your specific credit report, your score, your situation, you are welcomed and encouraged to call GreenPath Financial Wellness for a free, confidential financial assessment. GreenPath certified financial wellness coaches can review a soft pull of your credit report with you and talk about steps to build or improve your credit score based on your unique credit history. Coaches also can take a look at your budget and collaborate with you to develop an action plan to help you work towards your financial goals. GreenPath can also talk about other financial concerns or goals that you have in relation to things like housing, student loans, or options to manage debt. I do want to take a moment. We had lots and lots of questions come in the chat. So if you do have any additional questions, please go ahead and share those in chat. let me go ahead and pull up our list here, and I'm just going to start at the top. We're going to go through and answer all of these questions. First question I have for you, Eli, is for you, especially if you are in collections. Tell me a little bit more about late payments. When do late payments show up on my credit report?
That's a great question. So let's start off with the first thing. Every financial institution may or may not provide what's called a grace period. And what that means is that if your payment is due, we'll say as an example today, is October 16th. Your payment is due today. As long as you make your payment within this window, you will not incur a late fee. After that window, if the payment is still delinquent or past due, it does negatively impact your credit once it reaches 30 days of no payment. Now, I can't speak for any other financial institution, but what I can speak for with Schools First is that we do provide a 15-day grace period. As soon as it hits 16 days, that's when you would incur a late fee. And then every 30 days that a payment has not been made, that's when it negatively impacts your credit. So it's very important that we distinguish the difference between what is a late payment causing with a late fee and then a late payment as a derogatory report to your credit report. So the difference is that one is a penalty for not making your payment on time, and the other is reaching over 30 days of no payment, which does negatively impact your credit.
Thank you, Eli. The next question we have is, how quickly can you improve your credit score? Do you want to weigh in on that one?
So the question was how we can improve their credit
How
score?
quickly can you improve your credit score?
That is a great question. It all comes down to your debt to income ratio, or in other words, how much debt you have. And I think it's very important for you to look at all of your finances, all of your obligations. And in this case, maybe partner up with GreenPath to look at your overall financial spectrum and then work your way down as far as time. It can take anywhere between a year, depending on the amount of debt. Sometimes it can be 6 months. So it really comes down to your debt, your income, your financial obligations, and what you have available to you. And then once you get a plan, then you can calculate more or less how long it will take. But I would say in a fair perspective, it can be anywhere between 6 months to a year.
And I think the only thing I would add to that, Eli, is again, how you improve your score. The biggest piece of your credit score is on-time payments. So if you are working to get a better score, you want to make sure that payments are on time every month. And that's a 35% of your score. So on-time payments is going to be the best thing to help you to improve your score the fastest. Next question I have my credit report frozen with the 3 credit bureaus. I unfreeze only as needed. This is an excellent idea. Am I completely protected from fraudulent misuse of my credit, or do I need to put up additional blocks? This is a great question, and I can only say what I know and understand to be true. And I think a freeze is one of the best options that you can do. I'm sure I can't say, I can't be sure, but there is potential, I suppose, that there could be other ways that things could happen still. So you absolutely, even with a freeze on the 3 credit bureaus, you want to be diligent about what you're keeping an eye on and what's happening. So just again, keep a close eye on things is the best advice for anyone at any time. Next question I have, are medical debts showing up on credit reports? This is a yes and a no. Medical debts have just recently been changed for the rules, the regulation, the laws about credit reports. And I think it's been maybe a year since they've changed that, maybe not even that long. So yes, in the past, medical debts that went to collections, the collections would show up on your credit report because they were, sold from the hospital to the collection company. The new laws are talking a little bit more about medical bills under $500. They should not be showing up on credit reports. Again, I think there's a little bit more information. I would recommend that you do a little bit of a search and get some more information. And I would recommend that you give us a call so we can go through this with you and understand a little bit more about the debts on your own credit report or the concerns that you have about medical bills. And we can give you some more details. Again, the law just recently changed, so I don't want to say too much because I am not 100% clear on it. But going forward, more than less than $500 medical bill should not be showing up on a credit report. Some of the things that you can do to improve your credit score, as we mentioned, on-time payments. Number one thing to do, the best thing to do is on-time payments. That's 35% of your credit score. The next best thing is you can do is to improve your utilization ratio. In the example that we've talked a little bit about Diego and Angela and just that utilization in general, that's 30% of your credit score. So having a $1,000 limit on your credit card, you want to keep any balance at any time less than $300. That's 30% of your credit limit. And then time, more credit history, more months, more years with credit history. And then you can also do a little bit of a credit mix to have a credit card and a fixed loan. And then you want to limit the number of new credit applications. If you need new credit, you need new credit. I think we have another question I noticed in here as chat. I'll answer this now too as well. Any new credit applications will be on your credit report for 24 months. So 2 years. So if you do one application now, try not to do more applications for another 25 months, and then you're only going to see one at a time. Next question, can I have the credit bureau send the report to me versus printing it out myself? I think yes, you can. I don't know how many pages those credit reports are. I've never actually printed one myself. I just download the PDF and review it digitally. You would have to check with the credit bureaus directly to see if they can mail them to you. What is the difference between credit scores and FICO scores? Eli, do you want to weigh in on that one? What's the difference between a credit score and a FICO score?
So, to my understanding, a credit score is your your overall financial picture. So when we talked about earlier about a hard inquiry, right? The hard inquiry gives us the full picture of your financial history, payment history. Unlike a FICO, it's more like an average. So it's like the same, but it's not. They provide similar information, unlike the credit score provides specific information such as payment history, whether it was delinquent, past due, whatever the case may be, it goes into greater detail. And then the FICO would be like an average. More or less, I would say that would be the best explanation that I can have between the difference between a credit score and a FICO score. Did you want
Great.
to
I would
add on to
add
that?
to that, Eli, if you're curious, the difference between a Vantage credit score and a FICO credit score, maybe if you're hearing or seeing things online that they're using now a new scoring model called Vantage, it's just the algorithm, it's just the math between Vantage and FICO. That's the only difference. It's how they calculate it. What we've been sharing with you, the 35%, the 30%, that's based on the FICO score. Does requesting your credit report affect your credit score when you request it yourself? No, this is considered a soft pull, and you can check your own credit report now weekly according to the Fair Credit Reporting Act for no cost and no impact to your credit score. Let me go down the list here. I want to confirm that through annualcreditreport.com, yes, you can now receive a credit report every week for no cost. Annualcreditreport.com. Some great questions here. What if my credit report shows my employer long, lists an old employer? How do I get an address where I never resided updated? These would be considered things like a dispute. This is where you would connect with the credit bureau directly to let them know that there's wrong information. Now, an employer may not actually report to the credit bureaus. So I have this exact situation on my credit report. It has like 3 employers ago listed as my employer because that was with the bank and they reported it because of the financial industry. The new employers and even GreenPath for me doesn't report it. So it's not bad. It's not negative. If you are concerned because it's wrong, you can absolutely connect with the credit bureaus to create a dispute. So it's still a dispute because it's wrong information, and they should be easily able to fix that for you. Next question. What steps should we take if we have been notified by an organization that our information was compromised, such as social security number? Do you still have to notify the police? I don't think you have to notify the police in those situations. Unfortunately, this is becoming more and more common. I even just got like 3 different letters from 3 different places that my information was compromised because of hacks to the internet. So it gets a little crazy, a little overwhelming. However, in this situation, I think doing a review of your credit report to make sure that nothing is changing. I don't know if you have to do it weekly, but more often than once a year. And then putting a freeze. Putting a freeze with each of the 3 credit bureaus would be a great next step. That way you nor anybody else can get credit. Eli, tell me a little bit about this one. If I close my credit card from the store, will it affect my credit score?
That is a great question. So I know this is going to sound funny, but I guess I have follow-up questions. How old is this credit card? How long is this relationship? Are you constantly using this line of credit? Because all of that plays into any negative impact to your credit. But then let's transition to the next portion, which is what is your financial goal? What I mean by that um, is this credit card like a temptation? Do you no longer use it? Do you feel like you don't want to max it out? Maybe you don't like the rate. Maybe you don't like the benefits. In short, the straightforward answer, if you close a line of credit, it may make a negative impact to your credit. Now, if it's a brand new credit card that you opened in 2023, it's not going to make a major impact because it's less than a year old. But if you've had this credit card for, we'll say, 10 years, then it may make a significant impact to your credit just because of the years of the relationship. But I would say this, depending on your financial goals, what is your main objective? Are you trying to get rid of your lines of credit? Are you only trying to have one line of credit? What is your financial goals? What is it that you're trying to accomplish? If it means that you want to take this step in the right direction for your credit health, then you may want to do what's best for you in that situation. But the result is the straightforward answer is yes. It just depends on the length of the line of credit that you've had, the amount, and once it's been paid off, it looks great on your credit history. I hope, did you want to add anything to that, Jesse?
Yeah, I think you're exactly right. And the only advice I would give you to wonder if I should close the card or not is give us a call at GreenPath and we can take a look at you with your individual credit history and give you that best advice for your situation. What else do you have open? What are your financial goals? What are you trying to accomplish? And we can help you decide what's going to be best for you. Next question we have is how long do late payments stay on a credit report? Eli, anything there?
Yeah, I can answer that. So, any late derogatory payment, which is over 30 days of no payment, can stay on your credit report anywhere between 7 to 10 years, depending on the credit bureaus. Now, this derogatory reporting, like we were talking about earlier, it's very important to understand one of two things. Either one, is it in fact an error? If so, we highly recommend to dispute that reporting. Your credit score is very important, so you want to make sure that you dispute it. However, if you, for whatever reason, life happens, you were unable to make the payment for any difficult situation, That derogatory report will stay on there anywhere between 7 to 10 years. But as soon as you continue making your payments on time moving forward, it will reflect that your account is current. So, for the sake of argument, let's just say that you took care of September's payment late because now we're in October. You reached over 40 days of no payment and it negatively impacted your credit. So, in October, you paid for September and you paid for October. And then moving forward, you continue making your payments on time. Moving forward, your credit history will reflect that yes, you've had one derogatory reporting because of no payment in September, but moving forward, you will continue making your payments on time. Going back to what Jesse and I have been sharing, the importance of making your payments on time. That is definitely going to improve your credit scores moving forward. Anything that you want to add to that, Jesse?
Nope, I think that's perfect. Thank you, Eli. Quick question here is, as we've mentioned, paying on time can help improve your score and make sure that you have a good score and good report. Do I have to ask my landlord to report my rent payment history? No, you don't need to ask the landlord, and it depending on the company or if it's an individual, most likely they're not able to report rent as a on-time payment. However, they can, and they do report if you're late more than like 30, 60, 90 days, or if you're unpaid on your rent. So say you were evicted, that may show up as a collection. So unfortunately, most landlords will not report on-time payment history. Again, making sure that you're on time and you have the budget to pay on time will be a good step to not have any negative reporting. I can't recommend one credit bureau being better than the other. That's one of the questions. Which one is the best and why? They're all three. They're different. And another question we had in here too is why are they different? Well, there are three different credit bureaus. Creditors will report to the three at different times of the month. And so at different times of the month, your balance on your credit report may show a different amount. So they're going to have a little bit fluctuation in the credit score and what's happening on your credit report. But they're all three there for better or worse, and they're all three doing their job. So I can't say one is better than the other. What happens to a person's credit after they purchase an auto and try to turn it back in because they can no longer afford the payment? Doesn't the bank want the person to keep the vehicle and pay what they can as long as they pay something? How does that work? That is another whole webinar topic, but in a high level, I will let you know there are more resources talking about this on greenpath.com. We can give us a call and we can go through this question in detail with you. However, let's say, for example, you get an auto loan at $10,000. You drive the car off the lot. The value of the car has now depreciated less than the $10,000 loan that you have. Creditors, lenders, they're lenders. They're not used cars dealers. And so if you give the car back to the lender that you got the loan from, does not mean that wipes out the $10,000 loan. Yes, they absolutely want you to pay on that as long as you can and pay the interest, but not just what you can pay. It's the full payment or not. Otherwise, they're going to repossess the car. And when they repossess the car, either you give it to them because you can no longer afford it, or they take it back because you can no longer afford it. Usually what happens is the lender is going to sell the car at auction because they're not a dealership. They want to sell it as fast as they can. They get as much as they can. But that $10,000 loan and the car is only worth $5,000, you still owe the $5,000 that did not get paid at auction. And that will and can show up on your credit report as a collection. So that's going to be something that will negatively impact your credit score. Again, call us for more specific situations. We're happy to talk through this with you. We're going to go for a couple more minutes. I have a ton of questions here. I love the activity, the questions, the resources. I do just want to call your attention to the screen one more moment here. If you have a question that doesn't get answered today, I encourage you to call and give GreenPath a call. Talk with a financial wellness expert and we'll go through your financial situation, your pros and cons, what are your goals, what are your needs, and we'll help to recommend some actions that may help to improve your situation. You can give us a call at 844-218-6167. You can learn more at my.greenpath.com, or you can scan the QR code that is on your screen right now. I want to get to just a couple more questions here. Let me just get through my list here.
So
If any of you are joining from credit union or bank partners of GreenPath, yes, you absolutely can share this recording, these resources. All of the links that were shared, the QR codes, you can share those with your members, with your customers, with those and your friends and your family. There's never any cost to talk to GreenPath, and you can call as many times as you like. So absolutely share this information with others. Eli, did you have something to share?
yeah, I just wanted to add a little bit more about that overall spectrum about turning in the vehicle. Just one last thing, at least coming from a financial institution, from a collection standpoint, if the vehicle is voluntarily surrendered, or in other words, you're turning in the vehicle because you can no longer afford it, that's still considered a repossession on your credit. So even if you don't make the payments, the vehicle gets repossessed, or a voluntary repossession or a voluntary surrender of the vehicle will still reflect a repossession on your credit. So just wanted to emphasize that because that is a major financial decision. And like you were saying, Jesse, before making any major financial decisions, I think it's really important for you to get in contact with GreenPath. Let's take a moment to look at your overall financial situation and let's see what they can recommend, because maybe we can figure out a solution to avoid that decision. So I just wanted to add that to what you were saying, because the way that you emphasized on that was perfect.
I love it. Thank you so much for adding that, Eli. It's great resources there. All right, next question I have is, I have 2 credit cards, but only use one regularly. Do I have to make at least one charge per month on the second card so that it's active? Not generally. You don't always have to have charges on every card every month. It might be something that you want to make sure that you keep active by using it once in a while, so they keep it as an open and active card. There are some stores, some creditors, some credit cards that if you don't use the card after so long, they may close it. So indeed, check with that credit card company to see what their rules are. But as long as it's open and it's zero balance, it's still going to be marked as a paid on time because there was no balance due. What happens if you have more than enough available credit, yet you don't get approved for what you're looking to get approved for? I'm not quite sure on that question. Again, if you are still here, you want to clarify, I'd be happy to answer. I think that comes down to probably being a debt to income ratio. A lot of creditors are looking at the amount of debt that you already have, the available credit that you already have, and the amount of income, and the math in how much of your income is going towards debt payments. And that is certainly something that we can give you advice on, is how to help or improve your debt to income ratio.
I just wanted
All
to add
right.
to that.
Yes,
Sorry,
please,
Jesse, I just
Eli.
wanted to add it to that. So everything that you said is 100% accurate. When it comes to applying for a line of credit, a loan, an auto loan, whatever the case may be, it doesn't necessarily mean that you will always be approved, because everything comes into a factor. Like we were talking about earlier in this presentation, we talk about your debt to income ratio, the amount of debt that you have and the amount of income that you have. We also look at the amount of loans or auto loans or stuff that you already have under your credit. And that also includes anything that you're a joint on. For example, I do deal with a lot of members who lend to family. For example, they are a joint on an auto loan. We'll say, Jesse, you and I get an auto loan, and I'm your co-signer, but you're the one making the payments. Although you're the one making the payments, the loan is under your name, I'm also a joint. And that amount was approved because of our joint income and joint application. Therefore, that's also impacting your credit. So it's very important that when you are looking at any denial or any reasoning why you didn't get approved for a certain loan, it's very important to take a look at your overall financial spectrum, right? Your income, debt to income ratio, the amount of loans, debt, maybe accounts that are under collections, whatever the case may be, put that all together that may have impacted the decision. But like Jesse said, take a moment, reach out to GreenPath and see what they can do based on your personal situation. Just wanted to add that.
Thank you, Eli. And that fits perfectly into the next question. When you're married, is your credit score looked at jointly or individually?
I'll take, I can answer that. That also comes down depending on the circumstances, meaning wife, husband, partner, whatever the case may be, you have your individual membership. If you're applying together for an auto loan, for a credit card, for a personal loan, at that moment, two incomes are being involved for that decision. Therefore, yes, it will be both your spouse, your significant other. That is going to be a joint application. However, if you're applying separately, you have your own personal membership, your spouse, your partner has their own uh, accounts, then no. So it just comes down to your financial obligations. Because if you, we'll say a quick example, Jesse and I, for the sake of argument, in this example, we are married and we apply for an auto loan together. We have a joint auto loan, but then Jesse applies for a $5,000 credit card, and then I personally want to apply for a $10,000 credit card. That inquiry, we're going to look at the joint application. Therefore, they're going to look that Jesse and I have an auto loan together and any other accounts that are together or individually. So straightforward answer is if you are applying together and are applying to a joint application, yes, they're going to look at it together. But if you apply separately to have your own services, they're going to look at your income. So it just depends if your husband, your spouse, your significant other, what have you, if you guys are going to joint together and pay responsibly together, yes. Or the significant other is going to take care of the responsibility. But either way, what's very important and be very mindful of is that both parties are held liable and responsible for that significant debt, whatever they applied for. Jesse, did you want to add anything to that?
Yes, I would add just in general, the credit bureaus are going to track each individually. There is no such thing as a joint credit for what is being reported to the credit bureaus or being tracked for your credit score. So your individual credit score is always individual credit score. There's not going to be a joint score. Even if you have joint debts, your score is your score. A quick reminder, you can get your own credit report from annualcreditreport.com. We have just a couple more minutes before I have another webinar, so we're going to continue with a couple more questions here. We really do appreciate all of you staying here to listen to this Q&A. Again, we will have the recording available and we'll share that recording with everyone that registered. Next question, I think we'll make this one the last one. Would it be better to pay off a balance entirely or pay on it monthly? I would say in this case, it all depends on your financial goals. Do you have the ability to pay the balance entirely? How much is your credit limit? What is the time frame in which you are able to pay it off in full? Does it take you 3 months, 9 months, 12 months? Is it longer than that? Do you need additional help or support? So again, depends on your situation. And again, a great place to recommend calling GreenPath to get some additional advice on your specific situation. Anything to add there before we sign off, Eli?
Jesse, thank you so much for having me. It was a pleasure being here. To everybody that has joined us today, thank you for your questions. Thank you for your inquiries. We really appreciate your time. Last thing I will leave you guys with is hope you guys all have a great day. And if you are looking to improve your credit score, I would highly recommend to reach out to GreenPath. Jesse, thank you once again for having me. It was a pleasure being here.
Thank you, Eli. Thank you, everyone. Best of luck out there with your credit reports and scores. Reach out with questions and you can find GreenPath here anytime. Have a great day, everybody.